A pandemic hits, and within 6 months, the stock market is back at all time highs. Inflation in the United States reaches its highest level in over 50 years. And within a year, the stock market pushes to a new all time high again. A trade war disrupts the global economic system that has existed since World War II. And within just 3 months, the market recovers to record levels. Now, a geopolitical conflict emerges, disrupting the supply of one of the most critical resources powering the global economy. And within a matter of weeks, the stock market once again climbs back to all time highs. We've seen this pattern repeat itself over the last 15 years. Every correction is quickly reversed. Every dip is aggressively bought. But this pattern should not be taken for granted because the very forces that created this relentless buy the dip behavior are now beginning to shift. For most investors, this shift could be painful. But for a smaller group who understand what's happening and act accordingly, it may open the door to long-term wealth building opportunities. Over the past 12 months, the S&P 500 has risen by more than 50%. During that same period, real GDP growth in the United States has been around 2.5%. With rising oil prices due to geopolitical tensions, estimates suggest GDP growth may slow further, possibly ranging between 1.2% and 2%. It creates a strange picture. No matter what happens in the real economy, the stock market continues to reach new highs. But historically, this has not always been the case. Between 1998 and 2011, the S&P 500 delivered roughly zero annual returns on average, despite GDP growth being similar to today's levels. A similar pattern occurred between 1973 and 1980, and again between 1929 and 1954. Long stretches where the stock market did not significantly outperform the broader economy. So, this raises an important question. Why has the market behaved so differently over the last 15 years? If we compare the growth of the S&P 500 with corporate profits, we see that profits have expanded at a similar pace to the market itself. This growth has occurred through multiple crises: a European debt crisis, a global pandemic, energy shocks, trade conflicts, and geopolitical instability. Meanwhile, GDP growth in the US has increased at a much slower rate, less than a quarter of the stock market's performance. Even more striking, real personal income growth has been far slower, growing at only a fraction of that pace. This highlights a key divergence. How have corporate profits grown so rapidly while wages have remained relatively stagnant? And more importantly, can this trend continue? There is a well-known perspective from Warren Buffett that becomes highly relevant here. He suggested that corporate profits, as a percentage of GDP, are unlikely to remain significantly above 6% for extended periods. Today, that figure is close to 12%, roughly double that level, and it has remained elevated for over a decade. To understand why this matters, we need to consider how corporate profits typically behave. First, high profits attract competition. If a company generates unusually large margins, new competitors enter the market offering lower prices and forcing those margins down over time. Second, there is a natural feedback loop within the economy. If corporate profits grow too large as a share of GDP, it often means wages and other components are shrinking in relative terms. Since workers are also consumers, lower income growth reduces demand, which eventually impacts corporate earnings. This is why, historically, profits and wages tend to grow at similar rates over long periods. So, what has allowed profits to remain elevated for so long? While there are multiple contributing factors, one stands out as particularly important: the role of the central bank, specifically the Federal Reserve. During economic downturns, the Federal Reserve injects liquidity into the system and lowers interest rates to stabilize financial markets. However, this liquidity primarily flows through the banking system, which tends to benefit large borrowers, mainly corporations. As a result, during crises, significant amounts of capital flow into corporate balance sheets. A portion of that becomes profit, while a smaller share reaches workers in the form of wages. This structural dynamic has contributed to widening the gap between corporate growth and individual income. For many years, this system was supported by a low inflation environment. Throughout the 2000s and 2010s, core inflation in the United States remained relatively stable and below 3%. This allowed the Federal Reserve to respond aggressively to economic slowdowns, cutting interest rates and injecting liquidity without triggering major inflation concerns. But the situation has changed. In recent years, inflation has remained elevated, reaching levels not seen since the 1980s. As a result, the Federal Reserve has been forced to maintain higher interest rates, even as economic indicators show signs of weakness. Looking ahead, there is a realistic possibility that inflation could remain persistent, forcing the central bank to keep rates elevated or even increase them further. If that happens, it would remove a major support system that has benefited corporations over the past 15 years. Now, this does not mean the market will immediately decline. In fact, it could remain strong in the near term. But the environment is shifting. Higher interest rates increase borrowing costs, reduce liquidity, and put pressure on corporate profits. Historically, similar conditions have led to major market adjustments, such as in 2000, 2008, and periods during the 1970s. This is not necessarily a signal to exit the market entirely. Rather, it highlights the importance of preparation. Periods of higher volatility often create both risk and opportunity. Investors who plan ahead are better positioned to navigate uncertainty, while those who react emotionally often make decisions at the worst possible moments. The key is not to predict exact outcomes, but to understand the changing environment and adjust accordingly. Because when long-standing trends begin to reverse, the impact can be significant.